If you've reached $250,000 in your investment accounts, you've hit a major milestone. But now that your portfolio has reached this size, your financial strategy needs to change. At this level, your money starts doing more of the work than your monthly contributions do. You've moved past the saving phase and into a stage where small decisions, like tax efficiency and asset allocation, can have a massive impact on your long-term growth. I am Practical Wisdom, and I help people get 1% better with their finances. If you are new here, subscribe for content like this. Let's look at the specific moves you should be making right now. First, you need to understand the new math you're dealing with. That $250,000 is now a real income generator. Using a simple conservative average yield of 3.5%, your portfolio is producing about $8,750. That's over $700 hitting your account every single month. This isn't just a little bonus anymore. This is a real paycheck from your investments. That monthly amount could be your actual car payment, it could cover your utilities, or it could pay for a good part of your groceries. The feeling this creates is completely different. You're not just someone who saves money anymore, you're someone who owns income-producing assets. This is where passive income stops being a phrase you hear in videos and becomes something you see in your bank statement. You can decide to use this money to make your life a bit easier right now, or you can automatically reinvest every dollar to make your portfolio grow even faster. The important thing is that the choice is yours. And it's a choice created by your money working for you. At this stage, your main job changes. You are no longer just trying to save as much as you can. Now, you need to focus on protecting what you've built and making it work as efficiently as possible. The biggest threat to your efficiency is taxes. When you had a smaller account, taxes were a minor issue. With $250,000, they become a major drain that can cost you thousands. You need to think about asset location. This is a simple but powerful idea. It means putting the right types of investments in the right types of accounts. You should hold investments that create a lot of taxable income, like bonds or high-dividend stocks, inside tax-protected accounts like your IRA or 401k. This shelters that income from taxes. Investments that you plan to hold for a long time and that grow in value, like broad stock index funds, can go in your regular brokerage account, where you'll pay lower capital gains taxes when you eventually sell. This basic organization keeps more money in your pocket and compounding for you. Next, you have to become a fee detective. Every dollar you pay in management fees or high expense ratios is a dollar that isn't growing for you. On a $250,000 portfolio, a 1% annual fee costs you $2,500 per year. That's a huge chunk of your investment income just gone. Your goal should be to slash those costs. Move the core of your portfolio into low-cost index funds or ETFs. Look for funds with expense ratios under 0.2%. This isn't about being cheap, it's about being smart. The less you pay in fees, the more of your returns you get to keep. Over 20 or 30 years, this simple move can add hundreds of thousands of dollars to your final result. With a portfolio this size, market swings feel different. A bad month in the market could mean your account drops by $10,000 or $15,000. That can be scary and can tempt you to make emotional decisions. To prevent this, you need a clear plan for your asset allocation, your mix of stocks and bonds. Having a set plan, written down, acts as your personal rulebook. A common, sensible mix for someone at this stage might be 70% in stocks for growth and 30% in bonds for stability. The bonds won't earn as much, but they will cushion the fall when the stock market drops, helping you sleep at night and stay invested. Once a year, you should rebalance. This means checking your mix. If your stocks had a great year and now make up 80% of your portfolio, you sell some of that stock profit and use it to buy more bonds, bringing you back to your 70-30 plan. This forces you to do the difficult thing: sell high and buy low. It's a disciplined habit that pays off massively. Now let's talk about using your new investment income wisely. That 700 plusers per month is a powerful tool. The default and most powerful option is to set it to automatically reinvest. This means every dividend you get is instantly used to buy more shares. This turbocharges compounding because you're buying more assets that will themselves pay dividends. It's like a snowball rolling downhill, picking up more snow. However, if you still have any high-interest debt, like credit card debt, it might be smarter to take that cash and attack the debt. Paying off a loan with a 20% interest rate is a guaranteed 20% return on your money, which is hard to beat in the market. Using your investment income to destroy bad debt is a brilliant financial move. This portfolio size also opens doors for your other financial goals. That reliable dividend income can give you the confidence to max out your annual 401k or IRA contributions at work. How? If increasing your retirement contribution tightens your monthly budget, you can use a portion of your investment dividends to help cover your living expenses. This effectively lets you transfer wealth from your taxable brokerage account into your tax-advantaged retirement accounts, a huge long-term win. You can also start thinking about more advanced strategies like using a portion of your portfolio as collateral for a low-interest, securities-backed loan if you ever need cash for a major opportunity, like a real estate down payment, without having to sell your investments and trigger taxes. Your $250,000 in investments can act as a financial passport, granting you access to capital at rates far lower than a personal loan or credit card, often just slightly above the prime rate. You borrow against your own assets. The bank takes virtually no risk, and your investments stay right where they are, continuing to compound and generate dividends. It's the ultimate leverage for the disciplined investor, allowing you to seize opportunities without derailing your long-term financial plan. But the strategic advantages at this level go even deeper. With a portfolio of this size, you can begin to implement a powerful automated system of total portfolio management. This means viewing all your assets, your taxable account, your IRAs, your 401k, not as separate buckets, but as one unified engine. You can coordinate your investments across these accounts to maximize efficiency. For example, you might hold all your international stocks in your taxable account to take advantage of the foreign tax credit. You might concentrate your bond allocation entirely within your tax-deferred accounts to shield the interest from annual taxes. This holistic view turns your scattered accounts into a synchronized machine, where each part has a specific, optimized role to play. The result is a cleaner, more efficient portfolio that squeezes out extra returns through smart structure, not luck or market timing. Another critical move is to establish a formal cash flow cushion within the portfolio itself. Instead of keeping a large, idle emergency fund in a low-yield savings account, you can allocate a portion of your $250,000, say $25,000 to $50,000, into extremely liquid, low-volatility assets like a short-term treasury bond ETF or a money market fund within your brokerage. This segment serves the same purpose as an emergency fund, but does so while remaining invested and earning a much better yield. It's your personal treasury department, ready to deploy cash for emergencies or opportunities without forcing you to sell your core growth holdings at a potentially bad time. This strategy turns the concept of safe money from a drag on your returns into an integrated, productive part of your overall wealth system. Finally, this is the stage where your behavior as an investor becomes your most valuable asset. The market will test you with volatility. Seeing a 5-figure drop in a week can trigger a panic that wasn't there when the numbers were smaller. Your job now is to institutionalize your discipline. Create a simple one-page investment policy statement that outlines your target allocation, your rebalancing rules, e.g., rebalance back to my 70-30 target if any asset class drifts by more than 5%, and your criteria for any changes. This document is your constitution. When fear or greed screams at you to abandon the plan, you refer to your constitution. This level of detachment is what separates those who see their wealth compound from those who see it vanish in a cycle of emotional buys and sells. You are no longer just an individual trying to grow your savings. You are the calm, rational board of directors for your own financial future, making decisions based on protocol, not emotion. This disciplined stewardship is the final, non-negotiable ingredient that will ensure the powerful engine you've built continues to run smoothly, efficiently, and relentlessly toward the next financial horizon.